The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box Europe with Juliana Tattelbaum and myself, Steve Sedgwick, and these are your headlines. US stocks staged their biggest single one-day reversal since April. The Nasdaq swinging from a high of over 2.5% higher to close more than 2% in the red. As the strong jobs report, well, I think it was a mixed jobs report, but there were elements of strength within it. Anyway, that sees investors slash the odds of a December Fed cut.
The sell-off spills over into Asia and the region's tech stocks leading declines, while futures point to steep losses in Europe this morning. And a U.S. peace plan for Ukraine reportedly demands key concessions from Kyiv, including giving up land it currently controls and letting go of its bid for NATO membership.
They have been engaged with both sides, and these talks are continuing. It's a good plan for both Russia and Ukraine, and we believe that it should be acceptable to both sides, and we're working very hard to get it done.
Well, I have to hand it to you.
Don't hand anything to me.
Trust me, it is a begrudging handing it to you. But I can't deny, we were sitting here yesterday at this time, and you very clearly made the point that looking at NVIDIA's numbers, yeah, they were great for NVIDIA, but what did we learn in those numbers that justified the massive rally that we saw? And a few hours later, lo and behold, a stunning reversal.
I will go over my point one more time. Thank you for that. I appreciate that. Look, the point I was making is NVIDIA is doing great. We know that. But it doesn't tell any of you out there anything about all those burning questions that we have about the ex-NVIDIA environment as well. It doesn't actually tell us much more about NVIDIA. We knew NVIDIA was knocking the ball out of the park. We know they had the moat for now. We know they have 75% margins on their chips. We know it's fantastic. But it kind of endorsed the story. So you either love NVIDIA or you don't for its own merits. It didn't tell me anything about the revenues that can be generated from the hyperscalers. It didn't tell me anything about the decline in spending that capex that the hyperscalers are going to have next year and how that was going to affect their revenue expectations and then when they're going to generate net income from it. It didn't tell me that every company out there that's investing heavily in AI is going to generate profits from that investment as well. So if you had valuation concerns beforehand, you really had them more so on the back of NVIDIA. Because in fact, if anything, if you look at the counterfactual, okay, NVIDIA's doing great, people are buying more chips, but we still don't have the answer. So they're buying more, but we don't have the answer here. I want to just come up from a different point of view, and I've just thought of this as I was speaking to you about valuations. There are two types of, first of all, let's assume, is the market overvalued? Well, look, you lot over there say yes, you lot over there say no. Okay, so let's just go with the overvalued camp for now. Bear with me on this one, and I know some of you think it's not overvalued. If it is overvalued, there are two types of companies that are overvalued. There are the ones that are great and are going to be here, and are going to generate vast amounts of cash, and we know they're going to hang around, and we're not worried about them, but they're just highly priced. You know, the kind of big tech names or the ones that generate massive free cash flow, which they can pile back into, amongst other things, buying equity. So you've got the overvalued companies that are brilliant, and then you've got the overvalued companies that are rubbish. And my problem is, I don't think we're having enough of a wheat versus chaff split in those at the moment. So you've got the overvalued companies that are great, the overvalued companies that are just never going to make the kind of profits that they're promising. They're just not going to be there, so-called pets.com. Look, for instance, I think GoPro was a great device. I think the Fitbit was a great device. I think Alternative Meats, great idea. Alternative Milks, great idea. Ocado, the shopping company in the UK, great idea. But none of these companies has proven a sustainable profit path. And they didn't. So some of them are gone, some of them are still hanging on in there as well. So when you've got companies that haven't got a proven path to profitability, and are still massively overvalued, that's where the problem comes in the market.
Well, very clearly, it's early days when it comes to this technology, and investors are very humble about saying it's not clear who the winners and the losers are going to be, so we're just going to cast the net wide right now. I think the trouble is that even if you believe that we are in bubble territory, when you look at valuations across the board in the tech space, something has to pop the bubble, and you don't necessarily want to cash out too early because, as we've seen so many times this year, the rally can run on and on. And I would say right now, when you look at the market, what was the catalyst for the sell-off that we've seen? Was there a distinct catalyst? Maybe the fact that we've seen this massive plunge in Bitcoin, and that's impacted the liquidity of many shareholders that have cross stakes in a lot of these tech companies and in Bitcoin. But I think just because you believe we're in bubble territory doesn't necessarily mean it's time to sell your holdings or to short the market. And maybe yesterday what we saw, that early rally, was short covering because the numbers were so good, but not actually a change in sentiment.
I do not call the market. I see what I see. And I'm not saying the market's going to go down from here. I'm not saying the market's going to go up from here. But if you thought the market was great value when the Nasdaq was up 2%, you really think it's good value now. So presumably you're back in, unless you have liquidity problems, unless you have other issues as well. And that's the other point. A lot of the dangers in the market, the reason why the bears make such brilliant reading, bears make sense, bulls make money. The reason why they make so much sense is because there are so many other factors to worry about. You can look at consumer confidence on both sides of the Atlantic. You can look at the K-shaped recovery, something you've talked a lot about. You can look at the travails that President Trump is having in the polls and indeed on the most recent elections with getting across his message that we don't have inflation in the States. But then he takes off the tariffs on bananas and a whole host of other products. So there clearly is inflation. Americans are telling me there's inflation. They can feel that inflation. So there's macro issues. And then we came to that jobs report, which I don't blame our team, by the way, for saying was a strong report. But it wasn't. It was a very mixed report as well. Headline figure, much bigger than expected, but also unemployment rate up higher as well. So I think it was nuanced, and that clouded that December rate decision. And then that brings us back to the valuations. If we're really worried about the debt profile and the credit profile and the leverage profile of both investors and the companies, then we're really worried if rates aren't going down.
Yeah, I think that's absolutely key. And when you think about whether now is a good entry point, even with the Nasdaq now down more than 2% yesterday, you have to ask what's going to be the catalyst for further gains this year if we've got a Federal Reserve that now looks it looks very unclear whether they are going to cut in December. Nvidia earnings are behind us. So what's going to be the positive catalyst that drives markets from here? And on that point, I would just throw out there, to your point about President Trump and the pressure he's now under from a support perspective from voters, I wouldn't underestimate the administration's ability to come up with creative solutions to bolster confidence. We've seen it time and time again this year. I don't know what that would look like, but we have seen this administration very keen to intervene. Let's take a look at markets. And you can see where Wall Street ended up yesterday. You've got European futures on your screens now. We're looking at a sizable pullback when the market here opens, and that's because we, of course, saw this hefty reversal in sentiment yesterday, with the Nasdaq ultimately ending more than 2% lower. The Dow Jones ended 0.8% lower, swinging over 1,000 points intraday. It really was a stunning roller coaster of a session. You had the S&P 500 ending about 1.6% lower. In terms of U.S. technology stocks, here's a closer look for you at how some of the key names moved yesterday. Ultimately, Nvidia closed down more than 3%. Of course, when we were here this time yesterday, we were looking at Nvidia bouncing about 5% at the open. You had Advanced Micro drop almost 8%. Palantir, obviously a favorited stock among the retail community. That stock has been quite a big mover recently. It dropped 6% yesterday. Oracle down almost 7%. So very big moves to the downside there. In terms of Bitcoin, we also had a lot of movement in this crypto yesterday, falling below the 86,000 level, hitting its lowest level since April. So that's certainly a factor in the broader trade as well. In terms of Asian markets overnight, the negative sentiment has filtered there. You've got the Nikkei 225 down 2.4% over in Korea. The Kospi down almost 4%. So we are seeing sizable selling in some of the tech names in Asia as well.
So we mentioned the jobs figures and the opacity there as well. Just September non-farm payrolls, which was delayed, of course, showed the US economy adding a higher than expected 119,000 jobs. So that's good news, up from 4,000 jobs lost in August. The jobs report, though, said the country's unemployment rate edged up to 4.4%. Thus, it becomes more subtle, doesn't it? Its highest level since October 2021. Traders, though, are continuing to bet against a December rate cut from the Fed, now pricing in just 27% chance of a move lower, according to LSEG data. Cleveland Fed President Beth Hammack told CNBC rate cuts could risk keeping inflation above target.
I think that we need to maintain a somewhat restrictive stance of policy to make sure that we are continuing to bring inflation back down to our 2% objective. It's great that inflation expectations remain contained, but that is a place that I remain focused, that we continue to bring inflation back down to target. And so right now, to me, Monetary policy is barely restrictive, if at all, and I think we need to make sure that we're maintaining that somewhat restrictive stance to bring inflation back down to target.
And we'll get another take from the Fed when the Boston Fed President, Susan Collins, joins CNBC later today, 1300 GMT. Quick look at the US futures and whether we're going to see some form of stabilization. At the moment, there we go. A small rally, well, not a small rally, a decent-sized rally at the moment as well. But it'd be very interesting to see whether that evaporates again. A lot of positions are open, and as we all know, a lot of people close those positions ahead of the weekend. I'll tell you one thing, though. I don't know if you've got time to get the VIX up while I'm talking about it, because it's rallied quite aggressively. I'll tell you one thing, that decay happens every day. Depending on how you set your model up, you can either set it for 5 days decay for trading, or you can have 7 days decay. Getting a little bit into theta here, into the Greek weeds. But the point of the matter is, if you've got 2 days when there's no action, i.e. Saturday and Sunday, then you've got potentially 3 days of decay till you get your position on Monday. So if you are long premium, which is basically what the measure of the VIX is, it's a measure of the most active at the money vol, the VIX if possible. If you have got that long position, are you going to close it ahead of the weekend? That's what a lot of long premium traders do. But then, of course, on Monday, then you have to pick up the position again. It's a nuance, but just making you aware of it. Ozan Özkral is founding managing partner at Tanto Capital. Ozan, I'm going to ask you a very basic question. What do you make of what we are seeing at the moment?
I think the market is quite confused as to why this is happening. But then again, we've been discussing since the beginning of the year that the move that we witnessed so far in the markets is very sentiment-driven, momentum-driven, AI-driven, innovation-driven, with sprinkles of geopolitical risk, trade risk all around. So although we haven't got a specific reason why there has been a sell-off on the back of the strong NVIDIA results, to me it's not that surprising. It's only a matter of time until sentiment just shifts, because we just live in a much more uncertain world. I mean, you just mentioned in the program a minute ago, right? I mean, we have so many things to choose from. Long-term debt as an asset class, is it feasible anymore, right? If it gets repriced, what happens to people that have leverage? What happens to the corporate balance sheets that need to continue to borrow to continue growing and investing CapEx? Not everything is about financial markets. A lot of it is about also the real economy as well. So we have so many things that we can choose from to justify why there's a sell-off, but the reality is no one quite knows at the moment.
Does there need to be a catalyst, though, to see a sustained popping of what many say is a bubble? Because a lot of the factors that you just mentioned, they've been swirling around in the background for some time now. But ultimately, we've seen pullbacks, and then the market just continues higher from here. So do we need something to actually burst the bubble for it to be sustained?
I think it's a great question. I don't think we need to see anything specific, although there are a number of things that can happen that will make sure that this is sustained. But I think the most dangerous place we can be at is if this continues, even if it's at a low intensity, and the sell-off continues for a while longer, and then people and portfolio managers start thinking, hey, maybe, just maybe, we do need to kind of hedge out and kind of, either lock in gains or make sure that we redistribute the portfolio. I think that on its own is a dangerous mindset, but we are not there yet.
So that is the polar opposite of what I think.
Really? Amazing.
Yeah, that's what makes the show. Maybe I'm a little bit dramatic. That's not the polar opposite. But why shouldn't they? This is what really gets me about asset managers. And actually, do you want to get that VIX up again? Will's got it. He's got it ready for us. This is where the VIX is now. It's a fear index. Yeah, fear index, which is obviously not. It's trading at 26.4. It is up 56% over a 1 year period. It's up dramatically over last week as well. You just said a really dangerous place to be is when asset managers start taking out hedges. Why? Why shouldn't those asset managers put on hedges all the time?
Okay.
I don't know why, because they're benchmarked and they're terrible about losing a couple of basis points compared with their peers. But no, hang on a second, Ozan. I'm going to give you a full carte blanche. I'm just going to moan for a bit first. Why shouldn't?
It's that sort of a morning.
Bear with me, guys.
Okay.
It's a little bit of theatre. Okay.
Well,
it's TV. Why shouldn't they put on hedges more often? Why do they wait till the market dumps 5% before they buy the VIX and they buy some puts? Why shouldn't they actually have a hedge on if they're being responsible?
The short answer is all about the compensation cycle, is all about the human condition, is all about the way incentives are structured. And Steve, no one cares about the long term. Everyone is dead in the long term. No one even cares about the medium term. It's all about short term cycles. So it's unrealistic for anyone in the market to expect.
I should just ignore my adulation, my lauding of the great words of Warren Buffett. I should ignore Benjamin Graham. I should ignore Charlie Munger. I should ignore the greatest investors because they don't care about the short term. They care about buying good companies that are going to be there over the bit you just said doesn't matter, the medium to longer term.
Well, I'm not saying you should ignore them, But value investing takes a specific mindset and a specific strength of balance sheet and conviction to see through and have a truly medium to long-term view. All I'm saying is that your question was about asset managers. How many asset managers do you know that can afford to think long-term? I'm just saying that the reason why I think we are witnessing this sort of a reaction is because
can't they do what these brilliant your industry? How can't they do what the PE guys do? They've got this wonderful phrase: continuation strategies. We've got continuation funds. We've got continuation funds, which basically means they can't get out of something, so they've got it for longer.
PE guys. I mean, the era of cheap leverage. Okay, I mean, I'm not going to get onto that.
All right, I'm done. I'll get off my soapbox.
I kind of value a bit of Friday morning ranting. You know, it's okay. It's been that sort of a week.
Well, I think you're spot on. I mean, when you think about how much the market is now dominated, I have to say it's probably moved on from your days in the trading Fed.
Your days. Can I add one little point on that? I think one thing to watch out for, a data point to watch out for, is about that fiscal stimulus program that Japan is looking to exercise, that $135 billion or 21 trillion yen. The reason why I'm saying that is, this year we witnessed a couple of times government of Japan try to issue a 20-year, didn't really go down that well, a 40-year, didn't really go down that well. And they kind of settled on a 10-year part of the curve, which is really where the comfort zone for debt investors are. So my question to you is, since we're having a Friday morning ranting session, I'll take my time as well.
It's therapy, it's cathartic.
It's a fantastic way to start the morning, by the way, right?
I mean, my session, I've just been told that I'm old-fashioned and everything's moved on since my day.
Why or how could investors bet on long-term debt as an asset class? And what does it mean for the future of the cost of debt, cost of equity, cost of capital? Because no matter what the Fed does in December, or ECB, or Bank of England, or Bank of Japan for that matter, I think we're in an era where cost of debt, cost of equity, de facto cost of capital is going to continue to rise. And that is going to put a lot of business models under pressure, and they just haven't woken up to the fact that their going concerns may not have much of a chance in this brand new world. So I think that's the point that I would focus on. But the reality is year end. People need to get paid their bonuses, and it doesn't pay to be bearish unless we see a sustained level of a sell-off.
Well, this was going to be my point, that since your trading days, the market's become a lot more dominated by pod shops and multi-strat hedge funds, which have a completely different incentive structure. So even if you believe that the Fed is going to be cutting rates next year, we're going to get a more dovish Fed chair. If we're not going to get cuts in December and January, do you want to be positioning for something that's going to happen 6 months down the line? Right now, it's just not working.
You can't, it just won't pay, right? I mean, if you think about back into, what was it, June, July, summer of 2022, when the tech valuations, the era of revenue multiples were suddenly gone because Jamie Dimon went out and said, hey guys, maybe this is a little too heated. So, I mean, the market doesn't necessarily need to have a big event for the sentiment to shift. And that VIX numbers are interesting, Steve, because it does show, the fear index, right? But it really does take a cohort effort.
It doesn't show fear index. It shows. What is it? It's just a measure. Why don't we just remember what the VIX is? It's a measure pretty much of the most active, at the money, near month options contract. It's just whether people are buying or selling it. Look, if the market goes up, everyone's selling it aggressively, selling the premium. If the market goes down, people are buying the puts aggressively. But it never leads. This is my point. It never leads. It always reacts. Yeah, of course. So it's no more a fear index than looking back at the Nasdaq having fallen 2.5% in the previous session.
So what kind of a week do you think we're going to have next week?
I don't know. That's not my job. Your job. You're the one who's got to manage money.
So
I just react to it.
Look at just transpose the comp cycles. At least that's what I try to do. Try to understand who these portfolio managers get allocated through, and what do they feel like. And that point about Jamie Dimon, saying that the revenue multiples were crazy thing, it was the one comment that kind of made people think, oh, you know what, maybe they are. And guys, those that are allocating, start looking at cash flow, start looking at profits. So the sentiment shifted just through a couple of news flows that dropped in. And I think we are in similar territory right now, although we can have our picks from trade wars to geopolitical risk and everything being repriced. So happy days.
Nice.
Ozan, thanks for stepping in, creating a little bit of fodder for this morning's show. So thank you, Ozan Askrol, founding managing partner at Tanto Capital. Coming up on the program, the U.S. reportedly demands major concessions from Ukraine as it floats a peace plan to end the almost 4-year-old war. Plus, Scotland eyes the launch of government bonds amid fundraising efforts for infrastructure. We'll bring you Ritika's conversation with the country's first minister. And we'll discuss the European listing environment with the CEO of the Swiss exchange SIX up next.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
Business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that a society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Welcome back to the program. Euronext has secured a majority stake in Athex, integrating the Greek exchange into the group as part of the bourse's broader campaign to consolidate capital markets across the continent. We spoke to the CEO of Euronext about the decision and whether we can expect more integration across the EU's capital markets.
What we have built over the past 25 years, in particular over the past 10 years, is something where the numbers are compelling in terms of liquidity. We have a single technology platform, a single order book, a single liquidity pool. This liquidity pool trades every day something between 11 and 12 billion euros. The aggregate market capitalizations of the companies listed in this single integrated European pool of liquidity is above 6.5 trillion euro. This is more than twice the size of the London equity market. It is more than 3 times the Frankfurt equity market. We have built the largest liquidity pool for equity in Europe. M&A is a consenting adult game. You need to do a deal, a willing buyer and a willing seller. We are a willing consolidator of European market infrastructure, in particular in the equity space where the need is. I mean, the need for consolidation is above all in the equity space, because that's where liquidity matters the most. And that's where the antitrust issues are behind us.
Bjorn Sabern joins us now as CEO of SIX. Bjorn, it's great to have you with us in studio. Thank you for stopping by.
It's great to be here.
Let's pick up a conversation we were having yesterday with Stefan Bujna, because I think it's a really interesting one when you look across Europe from an exchange perspective, and that's around Chancellor Merz's recent call for one single European stock exchange. Do you see merit in that idea?
So first of all, it's a long and difficult journey to merge the exchanges across Europe. I think what we did, we acquired the Spanish stock exchange BME 5 years ago. We are super happy with that. It's one of the fastest growing exchanges in Europe in terms of listings, in terms of the momentum in the economy. So that's one part. We acquired also Aquis here in UK, the second largest MTF, the fastest growing if you look at it from the last 2 years. So I think consolidation can happen in many areas. What we did the BME acquisition. That's not only the exchange but also the CSD. And of course with Aquis, having a pan-European MTF where we can compete in 16 markets. So consolidation can happen in many ways. With Aquis, that gives us actually an opportunity, instead of just sitting and defending what we have, we can play offense and actually offer trading in 16 markets in Europe. By the way, competing with ourselves in Spain and Switzerland.
I certainly hear you around the merits of consolidation, the consolidation that you have done. But what about as a whole, when you think about how Europe can better compete with the US at a time when the US has been winning listings from both Europe and the UK, does it make sense to have a single exchange?
So let me start by saying, and I think I of course I followed the discussion with UK losing listings to US. But I think that's more a UK challenge. When I look at our value proposition in Spain and Switzerland, last year we had the 2 largest IPO in Europe, Butch in Spain, Galderma in Switzerland. The value proposition, the capital raise for those IPOs was super strong based on local interest, and then when the local interest is there, the global investors are coming as well. This year we had the largest in Q3, largest IPO in Europe with SMG Group. So I would say, yes, I follow the discussion from a UK point of view, losing listings, but I do not really say that's a challenge for a big part of Europe.
Great answers. Lovely to see you. In terms of, I used to look at the MTFs and the rise of the MTFs and just see it as whack-a-mole for the exchanges. Every time you buy one or you consolidate one, another MTF pops up, kind of thing. Is it still the threat that no matter how many MTFs you buy, someone can always come up with another trading platform?
I think, first of all, competition is great, and of course having Equis, that is the second largest MTF, and of course the SIBO as well.
You should tell people they're multilateral trading platforms.
Yes,
aren't they,
yes.
Yeah.
It's super important for the environment that you have competition. So the exchanges need competition. We need competition. I think it's great for buy side, sell side that there are opportunities out there. I think actually what the MTFs have done great, and that is what Equis have done, have not only a one-trick pony in 1 or 2 markets, but 16 markets where you can compete. So I think that's an important part of the market dynamic. And if you're a sell-side firm, if you're Morgan Stanley or Goldman Sachs, you can decide, I do some of my flow internally, I do some of my flow with the exchanges, some of it with the MTFs. That's a part of the market dynamic. That is great.
Yeah, very interesting, isn't it? The threat of the investment banks doing all the business amongst themselves with their own clients, which has been ever present. Tell me a little bit about the business model. Tell the viewers a bit more about the business model, because one thing that Mr. Boujnah, we like talking to all of you guys. You're all very robust, actually. I've noticed. Stefan, yes, is very robust, because we've got very, very strong trading proposition where other people have downgraded the value of their equity trading propositions, or the market side of things. And I think he was maybe making a dig at LSEG and what have you, talking about the role of data and what have you as well. Tell me a bit about what differentiates SIX.
So first of all, our starting point is Switzerland. And of course, in uncertain times, being Swiss and being a Swiss company is great. But I think actually...
Not this year.
Well, this year is also great to be Swiss. But I just want to say, so our starting point is the Swiss customer base. And then, of course, for us to grow Switzerland, it's not big enough. So we said, let's start on a growth journey outside Switzerland. That was why we acquired BME, so have a strong exchange inside EU. Then we expanded with Equis, so we have the MTF, so we also have the UK play. Yeah. So we are the only exchange that have Switzerland, EU with Spain, and UK. We can do that for listing, we can do that for trading. But where we are unique is we do not only do the trading part, we also have the full value chain in the CSD part. So also the settlements of trade. And when I look at the value proposition from the banks, the sell-side firms, it's not only about the trading, it's also that you offer the full stack, also the settlement part that needs to be efficient and smart. And on top of that, we also are a data company, so we provide data across the globe. We have a big team that sells data, corporate actions data, reference data globally. So I think actually, and on top of that, we have an index business. So I think actually we provide more or less the full offering towards our clients across trading, data, indices, and the post-trade part as well. That's where we stick out versus some of our peers.
Got it.
Bjorn, brilliant insight into how to think about the business model. Can I bring it to more recent activity in terms of what you're seeing, in terms of trade flows, in terms of investor flows, in particular, in light of all the headlines around US-Swiss tariffs and now the resolution, I think we can call it that, on the tariff front?
I think, first of all, that there is a solution on the tariff front for Switzerland is great. And of course, to have that certainty, at least clarification, is great for Switzerland. In terms of trading, I think for not only for us, for most exchanges, by the way, also for many of the buy side and sell side, it has been a great trading year, a lot of activity, more than we did expect. But what is also important for me and what I like is that the listing activity has also been great. If we look at our exchange in Spain, we have had 3 IPOs, but 11 listing on the growth segment. When I look at the pipeline in terms of IPO, it also looks strong for the rest of the year, but also for next year. So in terms of listing, in terms of trading, there's reasons to be bullish and positive. Stefan was that, I'm as well. This year has been in many ways a great record year for us, and we have been growing fast. But also the outlook for next year is, for me, actually positive, and I'm pretty bullish on next year as well.